We had the lowest volume of sales in Waterloo Region in over a decade. We did less business in real estate by a very fair margin than any other year in over 10 years. Population growth and net immigration. We
It's a
grew
lot.
6% in 23, but net international, 36,000, almost
Yeah.
37,000.
That's shocking, man. 6% increase in total population of the region from international.
Well, what we're starting to see is people have been coming here going to school, but the big schools are shutting down. A lot of their international student programs are getting cut dramatically. Current
Yeah.
government is kind of changing the tune. They can't be bringing in 500,000 people to Toronto every year without there being repercussions.
I mean, I think those are interesting stats, but I agree. I don't think you're not going to get 40,000 next year.
No, the win of the year, Adam, the win of the year.
That's
Our goal
huge,
this
man.
year was to buy an apartment building. We just closed about a week or two ago, 34 unit in London. We closed on it with 95% loan to value, CMHC MOI, cash flow right off the hop.
Welcome back to the Canadian Real Estate Channel. I'm Adam JD Martin, your host, and today I'm here with Zack from Phipps Brittain Real Estate. We're going to be talking everything you need to know about the Waterloo region. So, Zack, what's going on in the market today? What kind of update can you give us rounding out the year? We're recording this December 20th, so we are about to head into the holidays, man. What kind of news do you have for us?
Oh, baby. A lot of stuff personally going on in our portfolio in our real estate business. I'm getting a lot more inquiries than I typically do this time of year. Homeowners and investors starting to, peek around, especially after the last interest rate drop. Inventory just plummeting, which is normal for this time of year, but not normal for some of the heat I'm feeling from people, thinking about making moves and, thinking about making some sales and some purchases. So we're going to cover kind of 2024 in review for Waterloo Region. Not just like numbers. Numbers, I think, help give perspective, but also just some of the trends I'm noticing specifically for you investors out there. And also just like Waterloo Region as a whole for like where real estate and housing is likely heading for the next few years. We're looking at CMHC data. We're looking at rental data. We're also looking at big macro trends in Canada and Ontario to kind of guide what we want to be doing for the next 5 to 10 years. Also going to get into some portfolio analysis and some personal updates from our end. What we've done here in 2024, what we're working on in 2025. I got to share a photo for you guys real quick here in our, the Phipps Brittain Real Estate is, we're not a get it done perfectly for the slides. We're get it done kind of
I
team for the
like that,
slides.
man.
Practicality,
Yep.
practicality is better than perfection. So a perfect example of this is this big photo on the right here. It's a garage. This is what a garage looks like when tenants move out, right? Well, against our better judgment, we may or may not have allowed these tenants to take the garage remote for their car to, be able to click themselves in to park into their garage without getting out of their car. So that's, the smart and the nice thing to do. Well, the tenant may or may not have gotten into a car accident. Car got totaled. Tenant's okay. Don't worry. But they didn't take the garage remote out. So we lost the
Dang.
garage remote. They took it
Dang.
upon themselves to try and fix the garage and locked the code permanently. So oh yeah, baby. So they'd moved out. We needed to clean out the garage and allow the new tenant to move in, needed access to the garage. And so we had to not break in. We had to ask permission from the neighboring tenant's garage to cut a hole in it to go in through the inside out and
Oh
pop
my,
it open from
oh
there.
my God. Is that the neighbor's garage, that hole?
Yes. So listen, ladies and gentlemen, this is a story to relate to you other investors out there that are, going out there solving problems and getting shit done. Also, a friendly reminder that sometimes you just got to go out and handle some business. Real
Dude.
estate is very rarely a hands-off endeavor. And so just to encourage you people out there that have been trudging through problems and dealing with BS all year, I see you. I'm in the trenches with you. Me and one of my handymen went over there, cut that open, and figured out how to reset a garage. I'm learning new stuff every day, Adam. But
That's wicked, man. I appreciate the problems or profits element there. I think that's really fantastic. And obviously for the neighbor, he thinks you're over there trying to borrow a spoonful of sugar, and meanwhile you're
oh,
like, dude, I need to take a sawzall to your garage.
yeah, I'm gonna need access to this for about an hour so I can patch it up after too. I'm sorry, guys. So, but you know what though? What it comes down to is communication too. Like you got to be able to figure out how to get shit done. Every problem is solvable. And just to encourage people kind of heading into the new year. I love New Year's in the sense of like I get jacked up because I want to, hey, where did I screw up? Where did I fall short last year? I believe in getting a little bit better every day. It's not easy, but I do try to get into that mindset heading into the new year. And looking back on all the F ups or all the mistakes or all just the dumb stuff you have to deal with if you really do want to succeed, whether it's real estate or something else, friendly reminder for you guys and girls out there that are in the trenches. But the little picture there too, Adam, this was a couple weeks apart on different spectrums. Was I had just these tiny BS problems that I had to deal with and go out of my way to do that I didn't want to do or didn't feel like I needed to. And then a couple weeks later, my partner Matt and I closed on the biggest building we've ever acquired on a 34 unit apartment. And so it's like,
Congratulations.
holy cow, like you just have it was a good reflection moment for us. So we'll talk about that deal a little bit at the end of this video. We're going to do a deep dive into that in the new year, but just a friendly reminder for you investors out there that are getting after it. You got to get it done sometime. So for investors that aren't already on it, people that want to know about the Waterloo Region real estate market, weekly emails go out. We're taking next week off because there's virtually no inventory. Nothing's really going to be changing for the next week or two. But into the new year, every week, I send out an investor hot list on market deals, off market deals, market stats, tools, as well as any other. If we're doing events, any other events, we get first dibs there. So if you're not on the investor hot list, great way to stay in touch with us. And you get access to yours truly every single week. Link in the description. We'd love to have you there. Now, the presentation, the goods. The whole idea of this video for you investors out there, or maybe you homeowners that are looking to get a better grasp on real estate in Ontario and specifically Waterloo Region, is I want to go big picture stuff that's impacting pretty much everybody at every level of real estate and business and life here in Southern Ontario. And then I want to talk specific trends that we're seeing and how those reflect in our local market. So if you're a homeowner or you own real estate as an investor, you're considering Waterloo Region as potentially as a market to invest in short-term or long-term. These are kind of the big picture trends, and then we're going to boil them down into how they're really going to be impacting Waterloo Region. So Adam, the interest rate roller coaster. One thing that I found that was super interesting on that was a lot of the policies all regarding interest rates aren't to directly improve affordability in real estate or in cost of living. Specifically for real estate, most of the policies I've seen or changes I've seen are to increase mortgage affordability. And they're different things. How easy I can get people into a mortgage to afford properties at their current values is different than can I use interest rates and interest rate policy to make everything more affordable, including housing. Different conversations. Yeah. So I just want to really encourage people to be very critical about the interest rate environment and their expectations and what's really going on there. The reality is we did see interest rates ratchet up and then ratchet down quite aggressively. And I am cautiously optimistic that we will actually have some sort of consistency by the end of next year in the real estate market. I'm getting an underlying feeling that governments and policymakers are going to continue to use interest rate policy and changes to, maybe win over popular votes or to obviously do what they think is best for Canadians. But if we do a sharp peak in interest rates followed by a sharp decline, it's more than likely we're going to see some volatility in the interest rate environment for the next 2, 3, 4 years. Maybe I'll be surprised. Maybe inflation will get under control. Maybe business investment will get under control. But, Canada as a whole relies very heavily on the real estate market and the success of it. And if mortgages are more affordable, if policies are making mortgages more affordable, buying will pick up, investing will pick up, and the economy will start to see gains in that sector. And for a lot of people in Canada, that's in their best interest. But in terms of affordability, I don't know if this is going to help improve it short-term or long-term. That goes to inflation too, Adam. And I'll get your 2 cents here is cost of living in Canada has not improved. Cost of building has also not improved. And so Canadians are still feeling the pinch. There's kind of 2 sides on that coin. And I'm not sure what side you fall on, where you fall on the, hey, affordability's, slowly starting to get better, or we're just having a little breath before we continue on the things are really going to start getting less and less affordable like they have been for the last 10 years. I'm kind of
Yeah.
on I don't think affordability is going to improve short-term or long-term train. I don't know what your thoughts are on that.
Yeah, I mean, I think all of these things play a part, obviously, between interest rates, inflation, and employment. The fourth thing that I would add to that is immigration. It sounds like the current government has really turned off the immigration spigot in a lot of senses for a lot of places. So
Yeah.
I think that will also play a role in what we broader see as affordability. Like if there's not 500,000 people entering the GTA every year, I could see how that would have a positive impact on affordability. However, there's still a lot of people that entered the market that
Yeah.
probably entered and are renting or have been renting as they build up their credit, as they establish employment in Canada, as they finish their education in Canada, and then they're seeking. Well, a lot of people I think will seek to own a house, right? That's generally kind of the cultural direction. Is like you work, you build credit, you get a great job, you build a career, you buy a house. That's kind
Yep.
of the Canadian dream. So I think in the sense of that, like I could see how more of these people who have entered the country that are currently renting and building credit will enter the purchasing market in the future. And I could see how that could actually make things a little bit less affordable because they'll be entering probably obviously the entry level stuff, which is like condos, single family houses. And as they go through that and mature through their sort of career as a homeowner, that'll have impacts on the housing market itself. So I think interest
100%.
rates, I would love us to stop seeing the 50-point drops and the 50-point raises because obviously that does create volatility in the market. Inflation, the numbers actually aren't great for Canada. We posted pretty bad numbers recently for
Yeah.
inflation and employment. Employment, I'm kind of wishy-washy on. I mean, Southern Ontario is great. Generally speaking, we've got a lot of industrial, a lot of commercial, a lot of opportunity. And I think employment in Ontario is great, but across Canada, if we're talking about all of Canada, I think it's pretty rough. So,
Yeah.
Waterloo Region, I think there's always going to be jobs, right? It's the tech corridor. There's a ton of employment coming from Toronto or people that work in Toronto or the broader GTA. And there's a
Yep.
lot of companies that have moved to Waterloo Region, right? You've got Google there, you've got D2L, you've got the remnants of BlackBerry, whatever we're calling that today. But like there's some really huge tech companies there, but there's also a lot of other employment. Like even just down the road in Guelph, you've got a lot of automotive and things like that,
Oh
where
yeah.
people will travel to do that, right? They'll live in Cambridge or Waterloo and travel over there for those types of jobs. So
Yeah.
yeah,
I'm
I would
watching
say
the business development specifically for employment growth. Employment's one of the trickier ones to kind of find because it's not necessarily a leading indicator for real estate. But
yeah,
if people cannot consistently find work and there isn't more growth, whether it's in wages or whether it's in availability of work,
yeah,
like that is an underlying variable that will dramatically guide the long-term trend of a region. And
yeah,
like you just said, there's a lot of things going for Waterloo Region. The one thing I'm looking specifically for is what are big businesses doing? Are they going to continue to come and expand here in Waterloo Region, or are we going to see a big drop off in that? Typically, and I think generally expected, Waterloo Region will continue to grow quite aggressively because of all the reasons you just listed. It's not that far from the GTA. It's right on the 401. It's much more affordable than the GTA. We have massive universities and colleges that are pumping out skilled and unskilled, workers. And it's become an attractive area for high level business development and growth in the tech space, in financing, in development, in, a lot of industrial and a lot of manufacturing still around here in Guelph as well. So that's one thing personally I look for, but it's not necessarily a leading indicator like interest rates may be.
yep,
I do agree with that. The big swings in the interest rate, guys, just more volatility creates opportunity, but also creates a lot more risk. And your everyday homeowner needs less risk and more consistency.
yeah,
The savvy investors out there, they can navigate any type of market with a little bit more success, but Canadians as a whole, we need consistency in the interest rate environment. We need consistency with inflation and cost of living. And I do hope that the policies they're putting in place translate that next year, because this year we just haven't had much consistency.
yeah.
So
Well, we're also coming up to an election too, so I think that will have interesting
it took me everything not we're
consequences.
not I was like,
So
I so many of my points were going towards the political kind of
yeah,
perspective and implications, and I was like, that is just too big of a can to open. I
Well, let's
wish I
not
could have.
open it. But let's
I
say
wish
there
I
will
could
be
have chimed in on
consequences.
the last week on the big video that you guys did, because it is so important. But for my own sake, I was like, I can't bring that up because there's just too many levels of conversation I need to have there. But for this purpose of this video, how those things are going to relate to Waterloo Region, and some key takeaways for like people that need perspective on what's going on right now was we had the lowest volume of sales in Waterloo Region in over a decade.
Yeah.
So we did less business in real estate by a very fair margin than any other year in over 10 years. Inventory. We're going to go through the tables right after this. I want you guys to actually see the graphs and the numbers. Inventory, we touched 3 months for the first time in over a decade for I think 2, maybe 3 of the months this entire year. And then boom, right back down under 3 months of inventory. More importantly, I think a lot of people watch these videos to get fairly general advice on the real estate markets in general, and then specifically how those trends are getting applied to in Waterloo Region. A friendly reminder is if you're looking to do business at a level above kind of the average or the norm, you do have to get really specific. And what I mean by that is getting specific to the market segment, locations, and type of real estate that you're the most interested in and that you're going to be doing business in. Go deep on that. That's why clients will come to us, is because it's like, hey, what's your specific type of business you want to do? Here's everything we need to know about that specific market segment at this particular time, so you can make an educated, decision and action based on that. Where I'm going with that, Adam, is building and consumer trends are starting to shift in Waterloo Region as they did in Toronto about 20, 25 years ago. So as Toronto could no longer build out efficiently, they started building up way more aggressively. And the trends of the market and the consumer who's actually buying and owning and living in property are changing after the building trends are changing, if that makes sense. It is no longer economical for builders and developers to go build subdivisions entirely of, somewhat affordable detached homes. That doesn't happen anymore. The detached homes that they're building in Waterloo Region are double car garage, 2,000 square foot plus, million plus properties. So everything else is maybe a little bit of semis, but mostly townhouses and stacked townhouse complexes. If you want to be in the freehold market, that's pretty much your only option for new builds under $1 million. That being just in Waterloo Region, surrounding areas has some nice options, but what we're really seeing is the emergence, and not necessarily the emergence. I think the confirmation that the condo market is here and it's here to stay. And what I mean by that is it is not economical for builders, developers, and investors to build like they used to,
Yeah.
which means they're only going to build what they can make money on and what they think the market will actually absorb. Well, condos aren't very popular in Waterloo Region until about 10 years ago. And now 5 years ago, a lot more started, and now they're being finished. So we have a flood of inventory for these condos. And there's a shift in consumer trends accepting the reality that that is their only affordable option if they want to start in home ownership, and they're not making $300,000 a year and not getting help from mom and dad or grandma and grandpa or whatever it might be. So it is going to be interesting to notice the shifts and the adoption of people saying, okay, yeah, I am on board with the condo market in an area in Waterloo Region, which was traditionally you're going to grow up and get a good job and go buy a starter home, and you might be able to afford to stay in the starter home forever, or you might be able to afford to make an upgrade if you want kids or move to a different school zone at some point in your life, and then that's kind of it. Well, now there may be more levels to the Canadian dream, or the Canadian dream may change because what people can afford is dramatically different now than 10 years ago. So expect the markets to be really fragmented in the between condos, those affordable freehold markets under $1 million, and then detached homes. And why this is so important is in a market like ours that experience dramatically less volume, different segments acting differently will have a larger impact in the overall average data. So if you
Yeah.
guys are looking at just averages, the market as a whole, but you're looking to only transact in townhouses or only transact in duplexes or only looking at new detached homes, your perception of what's really going on in the market you want to play in is going to be very different than the reality. So
I think it's worth mentioning too that the people coming into KWC in large part, like there are a ton of students, there are a ton of people from Toronto, and there are a ton of people that have recently immigrated. So again, I think these people are actually more biased to liking a condo type lifestyle or being more used to a condo like
100%.
lifestyle. Because if you're coming from Toronto, you're not used to having a 2,500 square foot Victorian house and the cost associated with it, right? You don't need that. You don't need a
No.
giant side split. Like you probably have lived in condos, right? And so I think that that's actually like a reasonable thing to point out too. It's like who's actually in this region, and for the most part, like young professionals immigrate, and a lot of people that are recently immigrated to Canada, and people coming from Toronto, they're used to that segment.
And on that note, I'm not a condo investor,
Yeah,
right? That's just
me
not what I
either.
invest in for my real estate portfolio. We work with a lot of people that have had a lot of success in that space. And
Hmm.
like the way I see it is the next 5, 10 years could be the golden era of condos in Waterloo Region because what they're building now is in the best locations.
Yeah,
They're building them right along King Street, right along the LRT,
yeah,
uptown Waterloo and downtown Kitchener. Any old dilapidated buildings, any parking lots, anything where there is a premium spot, those are getting gobbled up now because the
yeah,
market just wasn't there for condo development 10 years ago.
yeah,
So, look, do I think the economics behind them make sense for every investor or every homeowner? No. It's like saying, every candy is for every person. It's not true. But as somebody who is into real estate and knows my local market, if I was into condos, I would be taking a hard look at them over the next couple of years
yeah,
because the locations that there's a lot of good buildings either already done or about to be done in like A plus locations that you will just not get again because
yeah.
that's where the condos are going to be for the next 50 to 100 years.
Yeah, and like
So,
uptown Waterloo, the amenities, right?
oh,
How beautiful it actually is. The beautiful food and restaurants and bars and right close to the universities. It's so
money.
vibrant. Like it really is a big city feel for what I regard as kind of a small city because it's so spread out, right? It
Yeah.
doesn't
And
feel like
then
a huge city.
the Kitchener train continuing to clean up the downtown Kitchener areas,
Yeah,
boys and
yeah,
girls.
yeah. King Street,
Yeah.
King
So
Street. Let's go.
King Street, let's go. All right, so here we go. We're going to go through median sale price. Just a quick reminder, Adam. This is December 2023. All property types, median sale price 689. We're going to fast forward to November of this year.
Boom.
Median sale price 725. We bumped up about 35, 40 grand in median sale price across all property segments. Now,
Yeah,
at the same time, we had interest rates still chugging up, and now at the end of the year, they're back down. But just like we had a fairly consistent market this year, if you look at it over just a 12-month window instead of just picking a month and then picking another month. So for me, if people were transacting this year, a lot of our clients were making boring buy and hold acquisitions. Thumbs up. Few people making some small value add purchases. Trickier to find, but if found, money to be made there in a slightly consistent, if not a slightly up market. But what I'm seeing is the trends in the different market segments are different. So we're seeing condo market's really, really, really challenging in terms of sales, purchases, volume of new listings, and volume of new units coming to market after completion as well, because the investor pool that we're acquiring those properties has really dried up. Right.
hmm,
Next up, they're not building a ton of semi-detached. There's not a ton of sales in that market, and the freehold townhouse market is extremely competitive. For you single family buyers out there that are looking for good value, small value add, i.e., single family to triplex conversion, single family to duplex conversion, still work, just very hard to find because typically you need to make those acquisitions under 600K. Buying detached properties under 600K is very challenging. So you just got to be out there hunting deals and throwing around offers. Next up, month's supply. This is great. Over here, this is 2021. The up and down is the seasons, ladies and gentlemen. December, the lowest inventory. December, January, the lowest inventory. That is consistent. Throughout COVID, all in this area, that just went out the freaking window. We weren't seeing normal seasonality. The trends were around COVID. Like, are there
yeah,
lockdowns? Are there not? Is the interest rate environment changing? Is it not? That's what was kind of dictating the market. We're back to normal, right? We're seeing inventory start to crash here in December already, where we saw a little bump in the fall, which is also fairly common in Southern Ontario. Most activity, highest average sale price in the spring, little dip in the summer, and then a little bump in the winter or in the fall, and then a big dip down in the winter in terms of prices and inventory. So seasonal trends are back. Inventory is still super, super low. We touched the three for 3 months last year. which is the first time in over a decade, Adam. As you can
Mhm.
see, it is on its way back down. Personally, I expect inventory not to really get anywhere above 3. If it touches 3, it'll be right back down the next month. There's a lot of pent up demand or a lot of pent up supply. Homeowners that were holding on to wait for asset prices to
Yeah,
recover. I don't think they're going to see as big of a bump in 2025 as they want in their minds after this last price
I
or
agree.
this last interest rate drop. So they may be in a position where they're just not willing to wait anymore. They got to move. That being said, we have enough demand. There's enough buyers that are on the sideline, getting the financing ready, looking to relocate for work or more affordable markets like ours compared to the GTA. I think supply is going to consistently be a problem in our local market. That's a trend that we're going to talk about in the video, but this is the one that really just made me laugh. So this is a graph of volume of sales in Waterloo Region trailing 12 months. So just like the aggregate of what would sell on a monthly or on an annual basis, month by month. And the reason I set it up like this was just to show we had such a big bump in activity through 21 and 22, even on the way down in 22, right? Typically, we should be around about 7,500 to maybe 8,000 sales in a good year. All right.
Yeah,
We are consistently at 650, 6,500, 6,600 throughout this entire year. We are, anywhere from 15 to 20%, even 25%, depending on the market segment you're in, fewer transactions. That means you other agents out there hurting a little bit, less deals for you guys to go around. Maybe we're getting a little bit of a cleanup in the real estate industry. That wouldn't be a bad thing, right? We're also seeing fewer people out there looking to move into a rental, looking to make that downsize or that upsize, looking to make that first purchase. There is just less business activity. So, a little side note, Adam, in this environment, you may see agents start to offer more incentives, builders to start offering incentives. You might also see mortgage brokers, financiers, banks start to offer more incentives for lending. People are really going to start to try and ratchet up to get more activity, to build more business because they've been hurting for the last year or two.
yeah,
So, pay attention to that. If it looks too good to be true, it is. But just know that there's a lot of pent up supply and pent up demand. And I think people are going to wait to see what February and March are like before they really hit the green light. I'm watching that really closely. And when we do our 25 preview or our spring preview in February next year, I'm going to be looking into that real deep. Really, really important to kind of advise you guys on what to expect for the next year. And the last little data point here we're going to do before we get back to the rest of the presentation, CMHC data. And this one's going to blow your mind. I got a really interesting stat at the bottom of this. So this is so important for you investors out there that are looking for long-term trends. We talked about housing starts. We talked about construction, under construction in the previous video about how, Ontario is really missing the mark in building more homes faster. Well, Waterloo Region isn't doing much better. The things that I've learned is government is consistently trying to put out policy and press release to show that they're really trying to work with investors and developers to improve the ability to bring affordable properties to market. But the math and the economics behind building in Waterloo Region, like most of Southern Ontario, is insanely challenging for the amount of capital, time, and risk you have to take to develop and build. On that note, though, little secret, one market segment that we're seeing opportunity in for anybody that wants to build or develop or wants new units is small to medium sized infill projects. So if you can go and do less than 10 units on a lot, or you can buy a lot, smash it down, sever it, and build 3 to 5 units on each of the new lots, the math works on those. So any investors, builders, developers want to start looking into those types of deals. Those are more suitable for, smaller to medium-sized investors and construction to pull off. But we are seeing opportunity in that space to build infill, purpose-built, 3 to 5 unit buildings. The math works on those in our market very well, and you get 3 to 5 brand spanking new units. I don't hate that at all, but the point of that is there isn't enough building happening in Waterloo Region. Not even close. We have 2,700 new housing starts year to date, and we have 5,900 under construction. Well, our population grew by over 36,000 last year. Uh-oh, we're a little behind, right?
Retro.
Uh-oh, right? Now, one thing that is also super interesting was I'm skipping through a bunch of this, guys, but I do highly recommend if you're interested in this, email me your specific questions or check out CMHC's website. Vacancy rates, okay. This is a little tricky. Vacancy rates actually climbed a little bit in Waterloo Region, but you're seeing the rental market soften in terms of how aggressive rents are growing. My expectations is rents were flat for this year, and I would assume they will likely be flat for next year. But the average rent, lots of people, ping me messages after watching the videos. They want to know what rental rates are like because you're analyzing deals or you're comparing it to other markets. According to CMHC, one bedrooms are about 1,500 and two bedrooms are 1,766, right? Now, is this a two-bedroom basement apartment in a 6 out of 10 duplex with no parking? Or is this a brand new apartment building, premium location, parking, all the features you need? There's a lot of variance, Adam. You know this.
Yeah.
You investors, you boys and girls out there that have experience know this. But if you need a starting point, CMHC's data is not a bad spot to start, and then just apply it to the type of buildings or assets that you're looking to acquire. Rental rates in a 60-year-old apartment building are going to be different than a brand new apartment building. You know that, but if you need clarification on what those numbers should be, send me a quick email. We got you covered on that. And this is the last part that I thought would be really interesting to you, Adam, and the other viewers out there is population growth and net immigration. We
It's a
grew
lot.
6% in 23. My expectations, it'll be closer to half that in 24, but the net migration was super interesting. We lost people interprovincial.
Mm-hmm.
Intra-provincial, we lost people as well. We gained people, but less than the previous year. But net international, 36,000, almost
Yeah.
37,000 positive growth just from international. Now, Waterloo Region has always been a melting pot. It's got schools, it's got different levels of employment, and it was traditionally much more affordable than other options of this size. Well, what we're starting to see is people have been coming here going to school, but the big schools are shutting down. A lot of their international student programs are getting cut dramatically. As well is we're seeing a change in policy, like you mentioned, Adam. Current
Yeah.
government is kind of changing the tune. They can't be bringing in 500,000 people to Toronto every year without there being repercussions. So we do expect the population growth, especially from international, to slow down. Will it
Yeah.
stop? No. Are we going to see 40,000 more people coming in from international areas next year? No, that's just not going to happen. It's not sustainable. The policies have changed. We're going to start to see the changes in the data once 24 data is out, once 25 data starts coming out as well. So I thought that was like whoa, that is a big surprise. I expected
That's
more people
huge.
coming interprovincial than what we did see. I thought for sure we'd see a lot more people still coming from the GTA staying, but we're seeing that change as a lot of people are moving to the States or moving out east or west because it's way more affordable.
Yeah, well, that and we also did see a fair drop in GTA pricing, right? Which this
Yeah.
kind of happens, this yo-yo between Kitchener, Waterloo, Cambridge, and Guelph, like and even Barrie. Like we see this across our markets. When Toronto has a dip in price, all of a sudden people start migrating back to the city, and then once we see the economy stabilize a bit more and Toronto bumps back, that's when you start seeing those
Yeah.
same people come out of Toronto because they can't afford to live on Yonge Street or whatever. And so they move back out to Kitchener, Waterloo,
Exactly.
Cambridge, Barrie, Guelph, all those markets benefit from that. But that's shocking, man. 6% increase in total population of the region from international. And that says to me, again, what we were talking about earlier is like that's where I see like condo market segments look real good for that. Townhouse market segments look real great for that. Rentals should look pretty good for that. I think those are interesting stats, but I agree. I don't think you're not going to get 40,000 next year.
No, no, I'll take
It's
it
just not
because
going to
that'd be
happen.
great for my holdings, but
Sure.
this will make it very challenging for affordability to
Yep.
take a breath. So now specifically for Waterloo Region, early signs of competition in the resale market, guys. We're seeing anything freehold under a million. Not a ton of it available, especially detached homes, guys. Rental market softening in 2024 a bit. This is likely also because we are seeing a slight decline. I'm expecting, data's not in yet, but I'm expecting a decline in international students and international migration here. which majority of those people will enter the rental market first and then purchase after a few years. So expect the rental market to probably be just steady in 25, but I wouldn't expect to see aggressive growth. And last but not least, top tier properties. I've said it here before, is because our market isn't holy crap insane like it was 3 years ago, you got to stand out if you want to sell. Top tier properties, priced properly, marketed well in every market segment, those are going. We're seeing the
Yeah.
condo market specific be the softest. We're seeing multi-units 5 and under be the softest as well, because investors in that space are either still feeling the pain or don't have the financing options available yet. That may be different now that interest rates are changing, or they just don't believe that the market's going to recover as quickly as they want it to. So they're saying, hey, maybe I'll get a better deal tomorrow if I wait. I don't need to buy what's available today. So we are seeing that different though in the 6+ units. So if you're into the commercial financing space at 6+ units here in Ontario, which you are, action on all those properties, even the overpriced ones. There is a huge demand for purpose-built real estate assets in our market. Institutional money, investors that could weather the storm that was the last couple of years, they've already been circling the wagons trying to pick those up. Demand is going to continue in those. And I think actually, okay, no, I got a good picture for later. We'll talk big picture real quick. I thought it's after this slide. Now, I would have loved to ask this question on the collab video that you guys did last week. We've asked it here before. Me and you had this conversation. The other correspondents have too. Is will housing affordability improve or decline long term? Adam, I make things stupid simple in my brain, and then I go deep, deep, deep on data. And for me, it's like, okay, is our system, are the policies set up to encourage and actually build more properties that people can afford to live in as quickly as we need them?
No.
Astoundingly no. So obviously, so
No.
painfully no.
No
Okay,
need to go further on that though. No.
done. So if not, then affordability will not improve short-term or long-term, which means asset values, rental rates will continue to appreciate over time. Done. So now I looked at, okay, what about homeownership versus renting? So I looked into other markets as well. Canada is a really young country. Our real estate markets, our economy as a whole is a very young economy, but we mimic the UK in very many ways in terms of policy and how things are done. UK has a 53% ownership rate. Canada's still at 66.5. Now, this is different in different areas and different provinces, but like overall, Canada's 66.5% home ownership. That number will continue to decline, is because it's increasingly expensive and increasingly difficult. The barriers to enter home ownership are only getting worse. So if it's only getting worse, fewer people will do it, fewer people can do it. So the percentage of home ownership will slowly start to decline. On top of that, if we have extreme population growth, that will diminish, I think. We kind of agreed on that point. And employment trends. Employment trends are really tricky to watch for because they are very region specific, even city specific. But if an area is continually seeing business development, if they are creating an environment where people can afford to live and people want to live and work there, then they will continue to develop businesses to increase employment and offer jobs. If people have jobs, they will stay. If they stay, they will rent or they will purchase, and the real estate market wheel will continue. But my big picture thought is, to put into perspective, is we have big time money that is investing in rental assets privately in here in Ontario and all over Canada. That makes it harder for your average Joe or your small time guy like me to go in and buy big ass apartment buildings and to build a portfolio in that space. Well, we're seeing in the States, we're seeing in Canada, big money is investing in residential real estate, whether it's companies gobbling up hundreds and hundreds of single family homes in the States, or pension funds and banks and credit unions and private REITs gobbling up purpose-built real estate assets and developing those properties in Ontario. And this was the picture I wanted to give, is we are very quickly getting to the few fighting the many for real estate assets.
Yes.
This is Helm's Deep. If you guys don't know, one of the best parts of a movie ever made. If you haven't watched Lord of the Rings yet, or you think it's lame, don't even talk to me. Don't email me. Stop watching my videos. We're not friends. Okay. I'm just going to draw the line right there, Adam. But the few will continue to increase their share of the market as things progress. And I really challenge people who are struggling to, if your goal is home ownership, or if your goal is to invest in real estate as a part to build wealth for you, your family, whatever it might be. If real estate is going to be part of your goals, take a serious look at how to start or improve as quickly as possible. The time is now. If for me, I see it as an opportunity. If I can buy at today's prices, I'm going to be laughing in 5 or 10 years. So for me, I'm really challenging people to really acknowledge what's going on with policy, what's going on with our real estate markets and our economics. Is the challenges will only increase the longer time goes on unless we see dramatic changes. For everybody's sake, I hope we do see changes. I do want consistency. I do want a level of affordability. I do want people to be able to afford the basic things they need, like housing. But all the signals pointing are that this is merely just a blip in the radar. Another couple of years, our markets should be firing in all cylinders again, and things are going to get very competitive. I hope it doesn't, but if nothing changes, nothing changes. So
one last point on that. It's something that maybe just gets overlooked in that conversation, which is just who has more buying power? The person that has an existing portfolio of 5 or more assets, or somebody with nothing, right? Buying your first home. Who has more buying power? And it's just the answer is so clearly and obviously the person with more assets has more purchase power because they can leverage all those existing assets and their income to qualify for new buildings. So the rate at which the aggregation to the center, right, the regression to the mean will increase actually gets faster the further
yes,
down this path we go. So that the
yes,
more that people accumulate property, the faster they will accumulate it as well.
yes,
And that sounds counterintuitive because of debt servicing and shit, but it's not, right? So as companies like BlackRock increase their momentum, as large REITs increase their momentum, as small investors continue to aggregate larger portfolios, it will undoubtedly become harder for you to match their purchasing power because they have so much access to leverage already. And as that happens, right, if people do continue to do that, if there's less supply, the same amount of demand, and the regulations don't change, and that environment remains hard to do while they're building less homes, all that means to me is that the homes are getting more expensive and appreciating faster, which again means the person who started sooner has even more purchasing power on their snowball compared to you trying to get into the market later. So, and again, we're talking about when this discussion is maybe framed or contextualized by like a decade or more. But as these macro changes happen, as we go from 66.5% home ownership down to maybe closer to 55 like the UK, you just really have to think about how these snowballs work and the type of challenge that it poses for you in the future. So really great point, Zach. I appreciate that.
perfect summary. The big can do deals at prices and terms and rates that you cannot. So just perfect summary. And I mirror that as well. For me, I just anybody that wants to get into real estate, if they think it's a good part of their investment portfolio, if they think it's a good part for them and what they want to achieve, like take a look at it as quickly as possible. Because like you said, the rate in which we will get to that intersection of home ownership, what people can afford, who's buying all the assets, that will only accelerate.
Yeah.
So that actually is a perfect transition to portfolio analysis. So I do this every freaking almost every day. I'm tinkering around what I should be doing with our stuff because I'm having conversations with my partners. I'm having conversations with my clients about what their portfolios are. I get some new ideas. I watch videos like this to kind of figure out what people are doing in different areas. So I just need you guys to define what our true goal is. It's very easy to get lost when you are in the trenches. And what I mean by that is you're swinging the hammer, you're managing tenants, you're working your job, you got the family. The reason why a lot of people get into real estate investing is to eventually give them more money and or time freedom. So if you are heading in that direction, but you are just doing a lot of the work and it's really stressful right now, that's great. You're heading in the right direction. But if you're already at a point where, you can start leveraging that, maybe you need to change your timeline because of your age or your family or your personal needs. For me, the way I look at my portfolio is, will this double in 5 years? So I say I put 100 grand into a deal. Is this going to turn into 200 grand with some level of confidence in 5 years or less? Okay, just as a quick benchmark to share people what one metric or one quick question I ask myself, that's one that I usually have in my back pocket for myself because I know I should be able to generate returns that will allow me to double in 5 years or less. Next, I look at What are my debts? What are my equity positions? How much cash flow? What is the likelihood that my cash flow is going to improve or decline? What is the risk associated with the position I'm in? Am I over leveraged? Am I equity heavy? Can I be more efficient with my equity? Is the cash flow even enough for me to stop working as much, quit my job, get rid of another source of income, whatever it might be? But analyzing the risk and the returns of your current portfolio, and that may not just be in the sense of like, what's your ROE? What's your ROI? How much, nominal cash is coming into your account every month. This is a more holistic view on what you currently have. Is it helping you meet your goals, whether that's your real estate goals, your personal life goals, your business goals? And are there things that you can do to either reduce your risk or improve your return that are possible with the resources you already have? So, quick optimization, low hanging fruit. There's so many. You have done a ton of stuff on this. The other agents and investors on here have done a ton of stuff on this. The low hanging fruit is way more obvious than you think. So if you guys have a portfolio, you have a property, you're thinking about adding more, like even a half hour or an hour call will dramatically improve the clarity on what you want to do, what you need to do, what's possible for your existing portfolio. Then you can just go right to action plan. What are you
Yeah.
taking responsibility for, Adam? What are you outsourcing? What are you hiring? Maybe you are just doing exactly what you should be doing because time is your best friend for the type of asset that you already have. Or maybe there's some small things that you can tweak that will reduce the amount of time you need to commit to it. The more time you have, the more time you have for yourself, your family, your own career, finding your next deal, whatever it might be. But for me, this has been a really good transition year to very critically analyze my portfolio again,
Yeah.
understanding where I fit in building and managing my portfolio, but also what can I be doing to our current holdings and our new holdings to really optimize them in the next 3 to 6 months. Once they're
Yeah.
optimized, it's just how hands off can I manage them so I can go start looking for more deals, so I can work with clients, so I can improve the other assets in our portfolio. But I don't
Yeah.
want to overcomplicate it. The offer is there. We do portfolio analysis for people all the time. Send me a message, guys. To wrap this up, though, the win of the year, Adam, the win of the year.
That's
Our goal
huge,
this year
man.
was to buy an apartment building. Mission accomplished. We
Beautiful.
started negotiating this in the spring. We firmed up towards the end of the summer. We just closed about a week or two ago, 34 unit in London. We closed on it with 95% loan to value, CMHC MOI, cash flow right off the hop. We
Dude.
got room to grow. Boring, buy and hold, low risk. I have a very high floor. I don't have a huge ceiling on it, but the risk is virtually zero on this. It is a boring buy and hold that if I do nothing for 10 years, us and our partners are going to do just fine on it. But there's lots of little things that we can do to really improve the operations, not just so the tenants actually have an awesome place to live, which, newsflash, that matters, investors out there. Just a friendly reminder, it's not what you can do in a vacuum. You are working with people that live in the property. This is their home. Don't forget
Yes.
that. You have to provide a safe, clean place to live. But once we optimize this bad boy, like, we are really excited to figure out how quickly and how much we could improve in the next 2 to 3 months. We will be fully occupied by Feb, and then we will be probably optimized by the end of Q1. That's cleaning up and adding some storage, that's adding some parking, maybe adding some laundry, cleaning up the common areas, doing some maintenance improvements to some existing units in exchange for a little bit more rent, lots of stuff. So for those of you that are looking to step into the apartment space, our goal was to buy one last year. That was our big goal, right? Hey, we're going to sell a duplex, and that's going to give us money to go buy a 34 unit property.
Let's go.
So we're going to break this down, Adam, in either the January or the February video next year. We're going to do a whole breakdown. I'm going to get some criticism from you. We're going to poke some holes on things that we missed. We're going to go over the action plan and practical things that you investors can do to get into these deals, as well as what to do when you actually acquire them. I want it to be a super practical video because, now that it's closed and it's in our hands, we can kind of lift up the skirt and show you guys exactly what's going on.
Awesome.
Um, and I'm excited. This is a great deal for us and our partners. It's a big step for us, but just like really pumped to share with everybody. So You guys want to know about that deal? We're sending out more info on the investor hot list. You guys want to know what we're thinking for 25? You want to get in touch with us for a portfolio analysis? Like, my only job is to connect with other investors or other people that want to become investors here in Waterloo Region and just share everything I know, share all the resources I know. If we give value, if we connect you with the right people, we help put you in the right direction, that stuff will come back to us tenfold. Myself and my partner are going to be in business another 20 years in Southern Ontario. We figured out kind of what the next 5 to 10 years looks like. We're going to attack that in 2025, and we're excited to share more about it. So if people have questions about what to expect, their specific properties, get in touch on the investor hot list, Adam. I'm fired up to get this first big acquisition under our belt. Pumped for 2025. I think it'll be a better environment for investors and real estate people in general.
Yeah.
Get back to some more consistency, get back to business for a lot of people, and pumped to see what happens in the political environment too. Like,
Yeah.
I think dust is settled in 24, but I think it will really settle in 25. And I think Canadians, specifically here in Southern Ontario, us real estate investors, by the end of this coming year, we should have a lot more clear direction on what we expect for the next 5 to 10 years. And
Yeah.
that just gives me more confidence to be able to advise our people, but also just for my own guidance and what I want to be doing with our portfolio. So for everybody that watched the videos this year, it's been so much fun. I mean, Adam, I've had a ton of this stuff is cool for me. I get to come on and talk about real estate for 30 minutes or an hour. Like, come on, how sick is that?
I
So I
know.
appreciate everybody that chimed into the videos, the comments, the Canadian Real Estate Channel team that put them all together. I'm just pumped for 2025. I can't wait to see you guys there.
That's wicked, Zach. Thank you so much for coming on the Canadian Real Estate Channel. I think there are a ton of takeaways from today, right? Be cautiously optimistic, set your goals, optimize your existing portfolios, and create an action plan to get into more properties if you don't already have a portfolio to optimize, or if you're looking to grow. So, Zach, thank you so much for those insights. I really loved how you covered the data today. I thought that was really important to go over those charts and just kind of take a look back in the past and see where we're at currently. And we can start to imagine where those trend lines are going to head as we go into 2025. So I'm looking forward to having you back on the channel. Until then, Merry Christmas, and we will see you in the new year.